So imagine you spend maybe $1.5 million on a luxury apartment in Singapore's most prestigious zip code.
Right. The ultimate dream asset, supposedly.
Exactly. You hold on to it for 15 years and then you finally sell it, but for a massive $1 million loss.
Yeah, and the crazy part is that isn't just some hypothetical nightmare scenario anymore. I mean, it's actually happening.
It really is. Today, we're looking at a landscape that is, well, it's experiencing a brutal structural divergence. The old rules of luxury property they've stopped working.
They really have. The whole paradigm has entirely shifted.
Yeah.
What we are seeing on the ground is that historical prestige it no longer guarantees capital preservation.
Which makes our mission for this deep dive incredibly critical for you listening. We are pulling directly from Q1 2026 market intelligence, diving right into the core central region.
Right, so that's districts 9, 10, and 11.
Yeah, the CCR. We're analyzing ultra-prime listings and breaking down current expat leasing benchmarks, but we do need to set the ground rules early on.
Yeah, we absolutely do. Look, the figures we discussed today, they're strictly indicative of current market behavior.
Right, it's how tenants and buyers are actively treating the market right at this very moment.
Exactly. So no guarantees on future prices or rents. And this is definitely not financial advice. Just think of this as a strategic framing of the data to help you with your own buy, hold, or lease decisions.
Beautifully said. So let's jump in. The overarching theme of all this data is, well, polarization. At one end, expatriate tenants have suddenly accumulated the strongest negotiating leverage we've seen in years.
This is massive leverage, yeah.
But then, in the middle tier, older CCR condos are bleeding value. Yet somehow, at the absolute apex of the market, trophy assets and good-class bungalows are smashing price ceilings.
It's wild. And the gravitational force pulling all these diverging trends together is, without a doubt, the 60% additional buyer stamp duty.
The ABSD, right, levied on foreign buyers. I mean, if you are an expat relocating to Singapore right now, that tax is mathematically punishing.
It's brutal. If you want to buy a $2 million prime property, you're literally handing a $1.2 million check to the government just for the privilege of the transaction.
Right, so purchasing out of the gate is largely off the table, making leasing pretty much the only logical first step for these folks.
Exactly. And the immediate consequence of that policy is this massive influx of foreign demand pouring straight into the rental market. But, and this is key, that demand is meeting an entirely new supply reality.
Because the 2026 rental market has softened a lot from those dizzying peaks of 2023.
Oh, significantly. We had a huge wave of new condo completions hit the market throughout 2024 and 2025.
So the supply crunch is basically over.
It is. The surge in available units fundamentally eased all that pressure.
And I guess it isn't just about supply either. The nature of the expat budget has fundamentally changed, like the era of the blank check corporate housing allowance.
Yeah, that's completely dead.
Right. Companies are managing relocation budgets much more aggressively now, which means tenants are incredibly price sensitive, even in the luxury segment.
They have to be.
So looking at the Q1 benchmarks for the CCR areas like Orchard, River Valley, Marina Bay, the numbers really show a normalization. A one-bedroom unit is currently sitting around $4,500 to $5,500 a month.
Right. And your two bedrooms are ranging from about $5,500 to $8,500.
And for a family, like a three-bedroom.
For a three-bedroom family unit, you're looking at roughly $9,000 to $12,000 right now.
So landlords who previously just dictated whatever terms they wanted are finding their units sitting empty if they refuse to adapt.
Totally. The balance of power is completely inverted.
It sounds like shopping for a car at the end of the month, right? The dealers are suddenly very willing to talk. The landlord suddenly has to prove the asset's utility, not just rely on its pedigree.
That's a great analogy. And I was looking through the recent leasing negotiations, and it's fascinating how tenants are wielding this new leverage.
What are they asking for?
Well, they aren't just haggling over the bottom line rent. Tenants are actually securing 2-year lock-ins at these stabilized rates.
No, to build a fortress against any future rent hikes.
Exactly. Locking in the rate is their primary defensive strategy, especially since corporate relocations historically pick up speed in the second half of the year.
Makes sense. Are they asking for anything else?
Oh, yeah. The secondary strategy is extracting lifestyle concessions. We are seeing landlords swallow pet-friendly clauses that would have been absolute deal breakers back in 2023.
Wow. And landlords are also having to fork out for minor furnishing upgrades, right? like a fresh coat of paint or new high-end appliances.
Right, or even reconfiguring layouts to include dedicated work-from-home study spaces. A District 9 address just isn't enough to secure a premium tenant anymore.
It has to actually function as a modern workspace. So for the expat listener, the strategic play here is obvious. You have the upper hand. Negotiate the multi-year lock-in and demand the lifestyle upgrades before you sign.
Absolutely. But, the ripple effects of that 60% ABSD don't just stop at the rental market.
Right. Every action has an equal and opposite reaction.
Exactly. All those wealthy foreigners are forced to rent. They are simultaneously removed from the buyer pool. And the sudden evaporation of the foreign speculative buyer has basically ripped the Band-Aid off a glaring weakness in the prime resale market.
Which brings us to arguably the most shocking data point of the week. Over the last 15 years, prices in the core central region grew by a really sluggish 18%.
Just 18%.
Right, and when you place that next to the outside central region, the OCR, which is essentially the suburbs, you see a massive capital growth of 45% over that exact same 15-year period.
The divergence is just staggering. People assume a prime District 9 property is this impenetrable fortress of wealth, but the resale data shatters that illusion entirely.
Do we have specific examples?
We do. Take a development like the Clift in District 1. We recently saw a seller exit with an $815,000 loss after holding the property for a decade and a half.
Ouch. And the bleeding isn't isolated either. Looking at OUE Twin Peaks in District 9, the 2025 resale data showed that out of 20 transactions, 19 were unprofitable.
19 out of 20.
Yeah, and one of those sellers took a hit exceeding $1 million. But wait, I have to push back here. A prime District 9 property is marketed globally as the ultimate real estate gold bar. How is it depreciating like a luxury car driven off the lot?
Because the market no longer values the postal code above all else. The depreciation is really driven by two brutal interacting mechanisms. The first is what the industry calls the quantum problem.
Okay, let's break down the math on that. So an older, say, 700 square foot, two-bedroom unit in the CCR might carry an asking price of, what, $1.54 million?
Right. And because the foreign buyer is basically gone, the only person looking at that 1.54 million unit is
a local buyer, right? Like a domestic Singaporean or a permanent resident?
Exactly, a domestic buyer. And usually that domestic buyer is a local family, which is precisely the issue. For that same 1.54 million quantum, that local family can go to the OCR suburbs and purchase a brand new, highly efficient three-bedroom condo.
Oh, right, because they need the extra bedroom for a child or a live-in helper or a home office.
Exactly. They will gladly trade the prestige of a District 9 address for the raw utility of an extra 300 square feet in the suburbs. The local buyer prioritizes livability over legacy.
Okay, so that's the quantum problem. What's the second mechanism pulling down these CCR resale prices?
Lease decay. It creates a terrifying financing cliff for buyers. So imagine a buyer going to a bank to get a mortgage for a CCR condo that is, say, 20 years into its 99-year lease.
Okay, so the bank looks at the remaining 79 years on the lease and instantly tightens its risk assessment.
You got it. They start applying far more conservative loan-to-value limits. So instead of offering a standard 75% mortgage, the bank might cap it lower.
Which means suddenly your prospective buyer has to front an extra few $100,000 in cash just to close the transaction.
Exactly. And when financing becomes that cash heavy, the pool of potential buyers just evaporates.
So you are left holding a compact, aging apartment that local families are too large to live in and that banks are too conservative to finance.
Right. It is a toxic combination for capital appreciation.
But I suppose market inefficiencies always create specific opportunities, right? Because CCR prices have stagnated while the suburbs surged. The price gap between the prime CCR and the city fringe, the RCR, has compressed.
Oh, significantly. It's compressed to a mere 10%. That is a 30-year low.
A 10% gap between the city fringe and the ultra-prime core. That's wild. So for domestic buyers or permanent residents holding a long-term view, this is a historic anomaly. You can access top-tier districts at a dramatically reduced premium.
You can, but you cannot blindly buy into District 9 and expect a windfall. You have to dissect the micromarket.
Right, because the micromarket dictates the property's entire destiny. Like looking at the sources, we can see two completely different narratives playing out within the same prime area. The Sophia Road enclave versus the new River modern development in River Valley.
Right, so let's look at Sophia Road. On paper, it should be a slam dunk. It is freehold, it is District 9, and it sits right near major transit lines.
Yet the data shows its growth has totally flatlined. But wait, if it's a freehold property, it is completely immune to the lease decay problem we just talked about. So what is suppressing the value there?
It's a severe demographic mismatch. The Sophia Road area was heavily developed over the last cycle with boutique, compact 1- and 2-bedroom units. Developers built them specifically for foreign investors who wanted to rent them out to single expats.
And the 60% ABSD wiped out that foreign investor class.
Exactly. So now, the early people buying are affluent local families, and Sophia Road just does not offer this sprawling, family-sized layouts they demand. It lacks the grand, low-density prestige of an area like Ardmore Park.
So the market is essentially declaring that a luxury zip code is entirely useless if the physical apartment feels like a cramped hotel room you can't fit a family into.
Precisely. Owner-occupiers are dictating the terms of the market, and they vote purely on livability.
And we see that exact voting behavior playing out at River Modern. It's a new launch in prime River Valley, but buyers are treating it as a completely different asset class compared to the older resale units.
Because River Modern's developers engineered the project specifically for the local family demographic.
Oh.
Over 60% of the units are spacious 3- and 4-bedroom layouts.
They completely abandoned the tiny shoebox investor model.
They did. And on top of the space, it is a direct underground link to the Great World MRT station.
Yeah.
And 70% of the units boast unobstructed views of the Singapore River.
Plus, the architectural focus is entirely on the end user. I mean, it's adjacent to park connectors, it features a sheltered walkway directly to a highly sought-after primary school. It's basically an intricate checklist of modern family demands.
And the market eagerly absorbed it. At launch, buyers cleared out over 90% of the River Modern units, achieving an indicative average of $3,266 per square foot.
Wow, and it isn't an isolated case either. Over at Union Square Residences, a penthouse recently set a staggering record at $18.5 million, breaking down to $3,828 per square foot.
So the lesson here for anyone looking to deploy capital in the CCR is incredibly clear. You must buy with the future end user in mind.
Right. So if you're targeting condos, you have to secure family-sized spaces, prioritize freehold status to bypass lease decay, and obsess over school proximity and seamless transit integration.
Exactly. Do not rely on the postal code to do the heavy lifting anymore.
Got it. Now, let's elevate the conversation to the absolute stratosphere of the market. If the CCR condo market is now dominated by local families and expat renters, where is the ultra-high net worth capital, the family office money, actually flowing?
It is funneling directly into trophy assets. Singapore has quietly transformed into the world's leading destination for this specific tier of wealth. Yeah. Current market intelligence reveals that 5.2% of all property listings in Singapore qualify as $10 million plus ultra-prime assets. That concentration surpasses both New York and Dubai.
Beating out New York and Dubai is an astonishing metric. And the sources highlight two incredibly distinct examples of how this wealth is being parked. The first is a rare freehold conserved corner terrace located at 124 Cairnhill Road.
Right, and the indicative pricing on that is $16 million, which translates to roughly $6,400 per square foot.
When you look at the architectural specs of that Cairnhill property, it becomes clear why it commands that premium. Behind a meticulously preserved heritage facade, you have a modernized interior featuring floating timber staircases, a private internal lift, and over 5,600 square feet of living space.
It operates less like real estate and more like a piece of livable fine art. These conservation homes in District 9 are bound by incredibly strict preservation guidelines.
Right, meaning the government permanently protects the low-density, historical nature of the street. You are buying a legally enforced monopoly on the architectural landscape.
Exactly. And then, you scale up to the heavyweight division, good class bungalows. There is a GCB currently listed at Bukit Tunggal in District 11, asking $38 million by private treaty.
$38 million, which implies an underlying land rate of between $1,700 and $2,100 per square foot. When we talk about a $38 million transaction for a single-family home, are family offices even evaluating this as residential real estate? Or is this purely an alternative asset class, akin to, like, hoarding physical gold or rare antiquities?
It is entirely an alternative asset class. The mechanics of GCB wealth are totally unique. Supply is permanently capped by strict urban zoning laws. The government is not creating any new good class bungalow areas.
And ownership is legally restricted to Singapore citizens, right?
Yeah.
Foreigners and permanent residents are universally locked out of this segment.
Right, so you have a permanently fixed pool of highly coveted assets being traded among an ever-expanding pool of newly minted, ultra-wealthy citizens.
It's a textbook formula for extreme capital preservation.
And the appeal for family offices recently skyrocketed even more due to a critical policy clarification from the Ministry of Finance regarding ABSD on non-strata assets.
Right. Without getting buried in the minutia of the tax code, the core mechanism is basically this. Because a GCB is a non-strata asset, family offices can utilize complex trust structures to facilitate intergenerational wealth transfer with profound tax certainty.
Exactly. They aren't looking at rental yields, and they certainly aren't worried about whether the central bank raises interest rates by 0.5%. They are using these properties to vault $38 million across generations, entirely insulated from the volatility that plagues the broader condo market.
It represents a completely parallel universe of wealth preservation, operating under completely different laws of gravity compared to the rest of the island's real estate.
It really does. We are essentially witnessing three entirely distinct property markets coexisting within the exact same prime districts, each governed by its own set of rules.
Okay, let's synthesize everything we've uncovered in this deep dive for you, the listener. If you are an expat tenant navigating the 2026 landscape, the softened market has handed you immense leverage.
Exploit it. Lock in those multi-year leases at current benchmarks and ruthlessly negotiate for the lifestyle upgrades, the pet clauses, the home office setups before you commit.
And for domestic buyers or those looking to capitalize on the historically narrow 10% price gap between the CCR and the city fringe, the mandate is utility. The million-dollar losses in older developments prove that a prestigious address cannot rescue a compromised layout.
So buy for the local family demographic. Demand space, freehold tenure, and proximity to elite schools.
Right. And if you are operating at the apex of the market, evaluating heritage homes or good-class bungalows, recognize that you are buying into a legally protected monopoly of scarcity. You are securing an intergenerational wealth vault that functions independently of standard market cycles. Before we close, I want to leave you with a concept that fundamentally challenges everything we've just discussed about prime real estate today. We have spent this entire session analyzing District 9, District 10, and the historical prestige of central postal codes.
Right.
But as global warming accelerates and urban density pushes the limits of the city's infrastructure, the very definition of ultra-luxury may be on the verge of a radical mutation. Will the billionaires of tomorrow even care about a District 9 address, or will ultra-luxury detach completely from the map?
This is a fascinating question.
Will the ultimate status symbol of the future abandon the postal code entirely and instead be defined purely by climate-resilient architecture, self-sustaining energy grids, and private access to unbuilt natural green spaces? As the city builds higher and denser, perhaps the ultimate luxury, the true Picasso of real estate, will simply be the ownership of empty space. Take that thought with you. We'll see you next time.